So I see a few of you on. I'm going to go ahead and get started because it's just past 10. Excuse me if I'm not looking directly at the camera because I do have the questions open on a separate screen just so I can have everything easily accessible. So welcome. This is Tax Tuesday. It's the first Tuesday of every month at 10 a.m. I go live and I answer questions that have been submitted previously and possibly some live questions if we get them. So let's dive in. Before I do that, actually, let me introduce myself. My name is Heather Ryan, and I'm the owner of Tax Queen. I specifically support digital nomad, RVers, anyone who's kind of running a nomadic business. I'm your tax person. So I help a lot of them out with their tax returns and tax prep and bookkeeping. And here we go. Let's dive in. Tax Tuesday. So question number 1. I have a client who insists on paying me in cash. What do I do with this? I've expressed concern and I want to be able to sleep at night. Well, first of all, there's not really a problem. Any way that a client wants to pay, I think is fine. Let me try to maybe interpret this because there's not any more background here. If you're a remote business, accepting cash might be challenging, obviously, because you're not in the same place as your client to receive the cash. That would be my biggest issue. But if you are in the same place as the client, I don't see any issue with them paying you in cash. Just making sure you have a bank account where you can go ahead and deposit that cash. Not an issue. And just make sure, if you're using a software, like QuickBooks or Wave, you have an invoice, you just mark it as paid in cash. So I think easy enough. I'm hoping I'm understanding that question. There's really not an issue with receiving cash. Let's see, number 2, we're talking about the Affordable Care Act and the premium tax credit that goes along with it. So this taxpayer turned 65 in 2022, but qualified for the marketplace tax credit. That's the advanced payment of the tax credit prior to turning 65. How do you deal with that? I'm thinking is really the question here. So when you're filling out for the premium tax credit, it is Form 8962, and you can do it monthly. That's absolutely fine. There's even a section for that if you didn't have it the whole year, the same amount a whole year. There are people that join it mid-year or leave it for various reasons. If your health insurance changes, middle of the year, you lose a job or you leave a job and now you qualify for the marketplace. So we're talking about the Affordable Care Act and buying insurance off the government marketplace for health insurance. So yes, that's Form 8962, and you're going to get a Form 1095A from the government, from the marketplace. So you will get that in January. It'll be issued maybe early February. And that's what you're going to use to fill out your tax return, and it's going to create that 8962 form as part of the tax return so that you can get the credit. So I don't see that being an issue, but just make sure that those forms are part of your tax return. Okay, moving right along, please feel free to write in any questions in the meantime. If you have them, even if they're related to a question that I'm answering, please don't hesitate to leave a comment, and I'll hopefully be able to get to all the questions today. So number 3, I've overpaid my quarterly taxes for the first 3 quarters. Do I still have to make a final payment for the year? Is there a penalty for paying taxes early? So there is no penalty for paying taxes early. There's only a penalty for underpayment or paying taxes late. So you're fine. If you think you've overpaid, then just don't make that 4th quarter. If you're not familiar with what I'm talking about, those who work for themselves or have extra income from other sources may have to pay quarterly estimated taxes, and those are paid, as the name sounds, 4 times a year. So April 15th, June 15th, September 15th, and January 15th. And it's okay if you don't make all 4 quarters. That's not an issue. If you just make 2 out of the 4 or 3 out of the 4, that's fine. If you earn, especially when you earn more of your money in the second half of the year, pay higher amounts. If you've paid more in the beginning, then just skip the fourth quarter. Not an issue at all. So that's good, right? There's never a penalty. They don't mind keeping your money early. Let's just say that. Just remember, this is for not just the IRS, but also for the state, if you have state income tax that you have to be making estimated payments. So my husband and I just started to sell our backpacks using a website instead of Amazon. Now we're responsible for paying state taxes. I created out. So this is actually, you're paying sales tax is what you're talking about. This is not income tax, this is sales tax. So you're collecting, as you're selling that item, so you're selling that product on your own website and you're collecting sales tax for the state. And really the question is, how often do you need to be making that state tax payment? And that is set by the state. And when you get your tax license, it will tell you, do you have to pay it annually, monthly, quarterly? It's usually based off of how much you plan on earning and how much sales tax you're going to owe. But the state is going to dictate that. I cannot answer that question for you because there is no one blanket answer for everyone. Just go back and look at your sales tax license, or when you filled that out, it should have told you how often you're going to have to pay. You may be able to log in and look at your account, and it will show you if you're a monthly or quarterly or an annual filer. And if you can't figure that out, then call the sales tax, the revenue department in that state to confirm how often. So if you are monthly, it is due by the 20th of the following month. So right now we're in December. We're paying November sales tax due, and you have to pay it by file and pay by December 20th. And if you had no sales, you still have to file. So you have to file a 0 sales tax return. So just to be clear, this is going beyond what was in this question, but I just want to be clear. And since we're talking about sales tax, go a little bit more into detail about that. Let's see. Question number 5. I started a new freelance side hustle and I got my first payment in my personal name, which was under $400. Before I officially registered my new business as a single member LLC. So let's address that first. Single member LLC is sole proprietor, makes no difference on tax return. On a tax return, if you are a sole proprietor or single member LLC, you file a Schedule C as part of your 1040. So the LLC actually does nothing for taxes, makes no difference. Still filing a Schedule C. So if it matters, my only payment to be collected for 2022, so the current year, is the $400 or less than $400. And so I'm going to actually give you a benefit here. If you earn less than $400 in a sole proprietor or single member LLC, because they're the same thing, Schedule C, 1040, okay? If you earn under $400, you do not need to report the income. Yay! No, just kidding. So if you started that in December, let's say, or November, towards the end of the year, and you just didn't take in more than $400 that year, then don't worry about reporting it for 2022 or that current year that it's happening. But in 2023, if you're earning more than that, so you've now earned 600 or 1,000 or 4,000 or 40,000, it doesn't matter. As long as it's over 400, you do have to report that on a Schedule C as part of the 1040. So I hope that's clear. As a sole proprietor, single member LLC, they're the exact same thing. They're reported the exact same way on a tax return. If you earn less than $400 as a sole proprietor or single member LLC, you do not have to report the income. Yay! Okay, so that answers that question, hopefully. And going forward, I'd like to separate my freelance work with 2 business names, one for online work and one for in-person event support. That's fine. You can have multiple Schedule Cs on a 1040. There can be 2, 3, 4, depending, if you have a spouse, one can be, yours, one can be related to the spouse. It doesn't matter. none of that makes a difference. You're still a sole proprietor though, single member LLC. So hopefully that answered that question, and maybe that was good news for you. No taxes on that $400, or less than $400, I should say. So let's see, next question. My hubby and I traveled to a new state. I'm going to leave out some details because I don't need to share this publicly, I don't think. So we can be on site for a contract. Can we include the cost to travel there, the cost of our campsite, and our groceries? So this is a loaded question. And if you're a full-time RVer, just because you have to go somewhere to be there for a contract does not make your mileage 100% deductible. So remember, when you're full-time RVing, you're moving your home, right? Your home is going with you. So the way the IRS states it is mileage is not for moving your home, but commuting from that campsite to the office would count as business mileage. And sometimes that can be, 25, 30, 50 miles, like depending on where they are and where you can find a campsite. So that mileage from, we'll call it commuting, right, at that point, because that's not your normal tax home. So I would consider that mileage for sure by taking the truck if you tow a trailer, or a car if you tow it behind a motorhome. So the mileage from the campsite to the person's office to work there temporarily, sure. If it's temporary. If it's long-term, no, then it's just commuting. As far as the cost of the campsite, no, that's your personal home, personal rent or utilities, however you want to look at it. I would not count that. And groceries are never deductible. Okay, groceries are just food. That's the cost of living. Doesn't matter whether you're in a sticks and bricks, apartment or a house, you don't ever get to take groceries. So that would not count. If he went out with that client, if they went out for dinner, or he took them out for lunch or coffee or something, maybe to celebrate the end of the contract or to just discuss business, then sure, that would count as meals, but just buying groceries does not count. So I hope that answers that question. I get that a lot, actually. A lot of clients they think they can take all of their mileage because they're driving for work, and it just doesn't work that way. It's really a sticky situation. Mileage, especially high mileage, is a big red flag. So I'd be really cautious there. Let's see, next question. I've paid a contractor $1,500 in 2022, so the current year. What do I do now? So if you paid a contractor, my first thing is, before you pay a contractor, get a W-9. Okay, W-9 is available on the IRS website. For whatever current year is, make sure that contractor is filling out that W-9 before you hand them any money. That W-9 tells you, as the business owner who's paying this contractor, how that person is treated for tax purposes. So it tells you their name, their address, and their taxpayer identification number, or EIN, if they are a business. And the reason why I say collect that W-9 immediately when you start working with the contractor is because contractors can come and go. So if you work with a contractor in January, and maybe it's just a one-time deal, collect that W-9 immediately before you pay them, because if it's a one-time deal, come the next January when you have to issue them a 1099, you don't want to have to spend time finding that person if you still have the current contact information for them. So before you pay any contractor, I don't even care if you're paying them $100, get a W-9, because throughout the year it might end up to be more. Okay, so $600 is a threshold. If you pay a contractor $600 in a tax year, you owe them a 1099 NEC, so non-employee compensation, that next January for that year, that previous year. So we're in December. Next month is January. So anyone who pays contractor in 2022, in January of 2023, you're going to have to file that 1099 NEC, and that gets filed with the IRS, possibly a state if that contractor lives in a tax state. Some states require it and some don't. And also you're going to provide a copy of that 1099 to that contract worker. So in this case, you paid $1,500. Make sure you collect that W-9 from them so you know about their taxable entity and their tax ID information. You can even, it can be electronically provided as long as the contractor agrees to that. That's fine. Many times, often they're mailed, but it can be provided electronically. Not an issue, especially for those who are nomadic. That's nice. So again, if you pay a contractor more than $600 in a tax year, in the following January, you're going to have to file a 1099 NEC. So you need that W-9 form before you pay them for that information. The other thing I will say about that is if that taxpayer fills out the W-9 and they are an S Corp or a C Corp, you do not need to provide them a 1099. Yay, less work for you. But you must keep that W-9 in your records for proof of that you've gathered that information and you know that they are not due a 1099. The other times when you don't need to file a 1099 is if you pay them via credit card, pay them via PayPal, or some other merchant services, because that merchant services is now issuing them their own 1099. So if you pay them via ACH or a check or cash, then you have to issue them a 1099. If you pay them via credit card or merchant services, no 1099 needed because the merchant services is issuing them that 1099. I'll go into a little more detail here. What is a 1099 and why do we need it? The reason as actually the business owner needs to file a 1099 is so that they can deduct, or you can deduct, the contract work as an expense to your business. Without filing that, you technically shouldn't be deducting it. So that's kind of how it works. It's just letting the IRS and the state know, hey, I paid this person or this business X amount of dollars. Remember, this is for business services only, not personal. So I paid them X amount of dollars throughout the year to help me as a contractor for my business. So that was the long answer. But in the short answer, file a 1099 in January of 2023. So the next two questions are actually very similar. So let's just go over them. I hear this is the last year to fully deduct a work vehicle. A truck is needed in my case. So we're talking about the last year being 2022. As a permanently disabled veteran, I received my license and tag registration for free, along with no personal property tax on my first vehicle. Okay, that's awesome. Great benefit. I love it. How would you handle purchasing this in my business name and doing and insuring it? So the second part to this question, I do have an LLC that I'm able to run it through, but not sure how to do this if I would lose these benefits. So the benefits of being a permanently disabled veteran with the registration and stuff for free. Okay, so that's one question. And the next question that I see on here is also related to titling a trailer under a business name. And so my quick answer is, don't ever buy a trailer with a business name. I don't care if it's an LLC, it doesn't matter. Just buy the trailer and use it. It can still be used for the business. If you're a sole proprietor, that is not an issue. It's very rare that I see it beneficial for a business to own the trailer. Okay, let's repeat that. So it's very rare that I see a business to actually own a trailer. As someone who's an RVer, who's living in it, okay? You know, landscape companies, right? They own trailers. It makes sense for the landscape to own the trailer. It says the name on it. It's used for all the equipment to haul it around to do their work. In our case, you're living in said trailer, okay? Even if you're doing some, taking it to go to job sites or whatever else, you're still living in it. So it's very rare that I see it beneficial. It's also very challenging. A lot of times it's difficult to register a vehicle under the name of an LLC. To get insurance, you're now looking at commercial insurance. There's just a whole lot of hoops, and I just don't see any benefit to it whatsoever. If you're sole proprietor, I recommend using a since we're on this topic, using a mileage app to track your mileage that you're driving for business. And that is way more important than registering a trailer and insuring it with the LLC or business name. So I like to use this. I will share this link. And let's see. One second. I did have the link here. So this is the mileage app that I recommend. And if you use the code that I'm sharing, you do get 20% off for the year. So I would definitely recommend using that to track any mileage that you're doing for business. And this goes back to that previous question we were asking about, commuting to a contract work, a site, going on site. So commuting from that campground to that site temporarily, tracking that mileage. So Mileage IQ is the app I recommend. You get 20% off if you use my discount code. And that is the only one to date that it has been tested in tax court and withstood an audit. So it records your drives and you would just tell it whether it's business or personal, and it needs all that information. So I recommend that. Yeah, so that's kind of those both of these questions are related to a business owning a trailer, and I just don't see the benefit. If you think that you're the exception, I encourage you to reach out to me on an individual level, and I'm happy to work with you individually. But it's very, very rare that I see an RVer owning a trailer in a business name be beneficial. And that doesn't mean that you can't have some business use, but yeah, individual cases I'll work with, but in general, that's my general rule. If you're living in it, and even if you're working part-time in it or something, running a business out of it, there's exceptions. I think I've talked about this. I feel like I have. If you have a toy hauler, so I've seen, an artist or even just a remote worker that runs a business with their computer, and they use that back garage space strictly for an office or a studio space if you're an artist. Then you do have a home office deduction, but it's very tiny. And the same thing for a bunkhouse. If you take that extra room and make it an office or a studio space, it's such a tiny deduction at that point. It's really up to you whether you want to take the risk or not. I mean, maybe you'll save like $10 sometimes, maybe up to $50. So it's up to the individual taxpayer. But that's really when I see as far as working from your RV. And if you think your circumstance is a little different, again, feel free, whoever asked those questions, feel free to reach out to me individually. So next question. I want to purchase a park model that I'll put on property for rental income, and I will use when I'm not in my RV. All right, so let's address that. And then there's actual question here. I want to address that. So a park model, if you're splitting it between rental, so personal use and rental use, you only get to take partial expenses based on the percentage of use for renting. So when you're renting it out, if it's 50% rented out versus 50% personal use, you only get to take 50% of the expenses as related to owning that stationary. We're going to call it stationary because you're actually calling it a tiny home. And if it's short-term rentals, right? So if it's a long-term rental, same thing, doesn't matter. It's a split use. So you're splitting personal time and rental time. So let's first address that. I know that wasn't even a question, but I wanted to address it because I know other people that do rent out their RVs, and it will be split. And then your actual question is, bonus depreciation allowed for the purchase of a park model? Absolutely not. A park model, and especially if it's being a rental, is actually just a home. It's depreciated 27.5 years. So anytime rental property is stationary, stays in one place like that, it's 27.5 years depreciation. That is personal, or rather residential real estate depreciation amount, 27.5 years. I don't know, that sounds ridiculous, but 27.5 years is the rules. I don't make them, just share them. So you are not eligible for bonus depreciation. That is not a piece of equipment. That is real estate. That is property. Okay, so that should hopefully answer that question. I kind of went into a little more detail. I like to go into a little more detail because I don't really know the background on these questions. So I like to make sure that people understand some of the background and for other listeners too. Let's see. This is my last question that I have, although I think I saw one come live. Awesome. Keep them coming if you have any other live questions. If I use my personal debit card to make business purchases, what should I do to make it easier when filing business taxes? I learned that this was a big no-no. Okay, so yes, it is a no-no. I always say make sure you're not commingling, so everything is split. Business expenses go on a business credit card or business bank account. Personal expenses go all on a personal bank account and personal credit cards. Everything should be separate. So what do you do if you made a business purchase? It's really not to do with taxes. It's also just to know your numbers. And that's really like, it's all kind of commingled at that point, right? Knowing numbers, so knowing income, knowing expenses, knowing your net profit is really important. Whether you're talking about taxes or not, you should be knowing those numbers. But you do need to know them for taxes, right? So we're talking about commingling numbers here at this point, or using them for dual purposes. How's that? Because we don't want to commingle our finances. So if you do use a personal debit card, just reimburse yourself. So if you've learned that's a no-no, go to that business bank account and say, okay, I made this purchase for $100, reimburse yourself, move the money from the business to your personal account, write what it was for. It was a reimbursement for X, equipment, or you accidentally paid whatever. You took your client out to lunch and you actually paid with your personal card. Just transfer the money over. So now it's going to show up on the business as an expense. And this is, it's less important when you're a sole proprietor, but I still say no matter how small you are, have separate finances, have separate bank accounts. So you're not going through at tax time or this time of year and remembering, oh, is this a business transaction or was this personal transaction? It takes a lot more effort to do that. If you just have everything in its own account, you know that everything in there is business related, everything is business income, everything is a business expense, and it just makes life much simpler for tax time, but also for you to know your business finances. So I will share a bank account that I like to recommend for online entrepreneurs, nomadic, digital nomads, whatever terms you want to use. So here, 1 second as I type this in. And this will come with a debit card if you're interested in that. And yeah, here's my link. And yeah, so I recommend using Novo. It's an online bank meant for online entrepreneurs. It's really great. And anyone who is familiar with Profit First, you can actually have separate accounts without having separate account numbers. So it's I think they call it reserve accounts or something like that. So you could separate out tax savings account, you can separate out, business savings or payroll or whatever, but all the accounts that you might want, but you would still only have one account. So it's really awesome if you're familiar with Profit First. So those are all the questions I got previously, but I feel like I saw one on here and now it has maybe disappeared. I thought I saw one, but let's see. So follow up on park model. My CPA says a movable asset on wheels that will remain in place. It would qualify for bonus. What do I know? Is that there is no clear answer. Yes, this is true. So it depends. There is no clear answer. I'm going to agree with you on that. But something that remains stationary and has a pad and has utilities connected to it, that to me is stationary. So that would be my answer to that, and that's how I would handle that. If you told me it was an actual RV, versus a park model. But mobile home is actually defined in real estate under depreciation. So and that's where it gets sticky. There's not a lot of clear answers. Someone was asking truck about not trailer. Is that about the registering it, insuring it? It's the same thing. I wouldn't even insure a truck for an LLC. A truck should be personally owned and track mileage, and you report the mileage on a Schedule C as part of a 1040 if you're a sole proprietor. And if you're an S Corp, it's handled a little differently. You would actually reimburse yourself for the mileage, but you'd reimburse yourself the standard mileage rate, whatever it is that year and however many miles you drove. But I would always own the truck and trailer personally, not through business. It's very rare that I see business own it. Someone said I submitted it. So you submitted it late. Let me go and see. I haven't looked at it, so let me go see. Let's see. I'm an S Corp status. Okay, that's great. I cannot for the life of me wrap my head around year-end cash assets. My accountant always had me drain my account with a few thousand excess that were in there at the end of the year and pay myself a shareholder distribution, bringing my account to a few $100s. Another accountant told me I do not have to do this unless I want the distribution, and the amount left over can just sit there. I have not understood how I must drain my account at the end of the year and start the new year from scratch, but I grapple with operating expenses for the month of January. I do understand the S Corp is ultimately paying the taxes, not the corporation. Ultimately me paying taxes, sorry, not the corporation. So my bottom line is when my corporation shows a profit of say 35,000 and only took 24,000 and $6,000 in distribution, then how's the excess? Okay, so really this is just a taxable of an S Corp. S Corp is a pass-through entity, which you seem to understand, but it has no difference whether you take the money out or you leave the money in a bank account at the end of the year. An S Corp is taxed 100% on the net profit for the year. So you have your salary, your W-2 salary, which you talk about that you have. So you're running payroll, but it doesn't make a difference. At the end of the year, if your S Corp has $30,000 in net profit, you're paying taxes. You personally are paying those taxes on that $30,000 of net profit from the business, whether you distribute it to yourself or you didn't. It makes absolutely no difference. So I hope that clears that up. A lot of tax accountants say to draw the money out unless you need the money in there. So yeah, it's really a personal choice whether you leave it in there or not. If you do take it out, it does count as distributions, but the distributions are not taxed on top of your taxable net profit unless you really, we're getting into a deeper water here, but it's all about basis. So if your distributions are greater than basis, you are going to pay tax on the difference. But in general, I see S Corp owners not having to, well, I've lost my train of thought. So yes, at the end of the year, it doesn't matter whether you leave the money in there or you take it out, it's all taxed. The net profits are all taxed. It is not taxed twice. I see your response to me. It's not taxed twice because you're paying. So like, let's say 2022, or let's go backwards. Let's say 2021, you have $30,000 of net profit, but $30,000 of net profit does not mean you have $30,000 in your bank account. Different, right? So if you have $30,000 of net profit, you pay the $30,000, you add that to your income for the year on your personal 1040, it's passed through to you from the S Corp and you pay taxes on it. So maybe you had at the end of the year, you had 10,000 left in the bank account. It doesn't make a difference. It's not what's in the bank account that matters. It's the net profit. So yeah, bank account balance makes no difference. Yeah, it's really about basis and yeah. And that's the distributions are taxed depending on basis. And if you're working with a tax accountant, ask them about the basis to your business. As an S Corp owner, you need to know your basis and they might help you track it. if you are not. So yeah, I hope that helped answer that question. S corps can be a little sticky, but yeah, that cleared it up. I saw one other response here. So I can't buy a truck for my business at all. I guess I would need to know your individual circumstances. It's very rare that I see a truck needed for business. So I would just take the mileage. Depending on what you're doing and your business structure, if you're just a sole proprietor, track your mileage. I shared the app, track it, and that's what you're going to be taking. There's no benefit to having the business own the truck at that point. So let's go into a deeper explanation. There's two ways to take mileage or to take vehicle expenses. And one way is standard mileage, right? So the IRS sets a number, a cents per dollar, a cent per mile. So in 2022, this is a weird year. We actually split the year half and half. The IRS raised the rate. So the second half of the year, it was 62.5 cents per mile driven. So if you take that, you don't have to worry about the truck owning, who owns the truck or any of that other stuff. The other option is to take actual expenses. Actual expenses means cost of registration, cost of insurance, cost of maintaining the vehicle, gas throughout the year, tolls, parking, although you get to take that regardless. But yeah, so you have to track all of your expenses and mileage, because you still need to know how much was that vehicle driven for business or personal use. So by taking actual expenses, you have more work to do, quite honestly, more bookkeeping, more record keeping to worry about. And I almost never, very rarely, I should say, do I see actual expenses being greater than the standard mileage deduction over time. The other caveat is that if you take actual expenses in year one, you must continue to take actual expenses for the life of that vehicle. You cannot switch back and forth. So that's a huge one as well. So yeah, that kind of answers that. I hope that answers that question of why I do not recommend taking the truck as actual expenses and having the business own it. I rarely see a benefit to that, especially as a sole proprietor business owner. And trucks do not qualify for, well, it depends. It depends on the vehicle. Big trucks, you can take depreciation on it, but again, over the life of the vehicle, you have to look at this. So it's not just 1 year. We're looking at, this is part of tax planning. So this is what I work with my clients on individually. So we're not just looking at the 1 year. So I'm not looking at 2022. If you're going to own that truck for 5 years, 6 years, 10 years, what is the life, right? So as we continue to use that truck for business, what does it look like? So what's the best tax benefit over time, not just 1 year? So let's not be short-sighted. Let's look long-term, unless you plan on buying a new truck every year, which I don't know too many people do that. So just be really cautious with that. And that's why I say it's really no benefit to the LLC or the business owning the truck. So I hope that answers that question. However, was the comments disappear on me, and I'm not sure why. There's only so much room, I guess. But I hope I answered everyone's questions and gave a good explanations. And I appreciate you all for being here. I'm going to wrap up unless there's something else, another comment or question that's coming in. But yeah, I hope to see you at the next one. The next one is January 3rd. So the first Tuesday, remember the first Tuesday of every month at 10 a.m. So mark your calendars, get those questions submitted. Oh, wait, there is a question. I thought I had seen something about solar and it disappeared on me. So we had a full solar system install on our Airstream, including panels, inverters, and batteries. What address do I use? My domicile address, domicile. I've never put an address, unless the form has changed for this year. I've never put an address on there because I just mark it as it's for your main home. And so, yeah, I've never had to put an address, but it should be your domicile address. So, because that's asking you where the equipment was installed, which is your home.
which is based on your domicile. Yeah, so I hope that answers that question. I thought I had seen a solar thing, but I only see so many comments, they disappear. The joys of using Facebook to go live. Anyways, I hope that answers your questions. And I hope to see you, like I said, next one is January 3rd, 10 a.m. Mark your calendar, submit those questions as they come up. I'm anticipating the January, February ones to be a little longer because we are going into tax season, and I'm guessing that it's on the forefront of people's minds. So there will be some questions, some good questions. I think these are all great questions, and I appreciate you all being here. And until next time, take care.